The Relative Vigor Index, commonly known as RVI, is a momentum oscillator developed by John Ehlers. It measures the conviction of recent price action and calculates the probability that price movement will continue in its current direction. Let's look at how RVI is visualized. Here we have a price chart with the RVI oscillator below it. The RVI oscillator typically ranges between 0 and 1, with values above 0.5 suggesting bullish momentum and values below 0.5 suggesting bearish momentum. What makes RVI unique compared to other momentum indicators is its approach to price comparison. While most momentum indicators compare the current closing price to previous closing prices, the RVI compares the closing price to the opening price. To summarize, the Relative Vigor Index is a momentum oscillator that measures the conviction of recent price action by comparing closing prices to opening prices. It oscillates between 0 and 1, with readings above 0.5 suggesting bullish momentum and readings below 0.5 suggesting bearish momentum. The Relative Vigor Index formula compares the closing price relative to the opening price to determine market vigor. To understand how RVI works, let's look at a series of price candles. The RVI calculation involves 5 key steps. First, we calculate the difference between closing and opening prices for each period. Second, we apply a moving average to smooth these values. Typically, a 10-period moving average is used. Third, we calculate the difference between high and low prices for each period. Fourth, we apply the same moving average to these high-low differences. Finally, we divide the first smoothed value by the second, creating the RVI ratio. Mathematically, the RVI formula can be expressed as the numerator captures directional movement by looking at close minus open, while the denominator captures volatility by measuring the high-low range. This creates a ratio that measures the strength of price movement relative to its trading range. Higher RVI values indicate stronger bullish momentum, while lower values suggest bearish pressure. Understanding the formula behind RVI is key to applying this indicator effectively in trading analysis. RVI differs from other momentum indicators in several key aspects. Unlike RSI or MACD, which focus primarily on closing prices, the Relative Vigor Index examines both opening and closing prices. The RVI takes a more comprehensive approach by examining not just the closing prices, but the relationship between opening and closing prices. In contrast, RSI and MACD rely solely on closing prices for their calculations, missing potentially valuable information from other price points. The RVI incorporates the high-low range in its calculation, providing insight into volatility alongside momentum. This dual focus helps traders distinguish between strong trends and random price movements, offering a more complete picture of market dynamics. This makes the RVI particularly useful for measuring intraday momentum, where the opening and closing relationship provides valuable insights for short-term trading decisions. Let's examine how to interpret signals from the Relative Vigor Index. The primary signals from the RVI indicator come from crossovers between the RVI line and its signal line. When the RVI line crosses above its signal line, it generates a bullish signal, indicating potential upward momentum. Conversely, when the RVI line crosses below the signal line, it indicates bearish momentum and a potential downturn. Beyond crossovers, the actual values of the RVI provide important signals. Readings above 0.5 generally suggest bullish conditions, while readings below 0.5 indicate bearish conditions. Extreme RVI readings provide additional insights. Values approaching 1 may indicate overbought conditions, while values approaching 0 may suggest oversold conditions. Both extremes can signal potential market reversals. To summarize, the key signals from the RVI indicator include crossovers, threshold values, and extreme readings, all providing valuable insights for trading decisions. These signals provide traders with a framework for making informed decisions based on RVI readings. Divergence analysis is a powerful technique used with the Relative Vigor Index. Divergence occurs when the price movement doesn't align with the RVI indicator movement. Bullish divergence appears when price makes lower lows while the RVI indicator forms higher lows. Notice how the price drops to lower levels while the RVI forms progressively higher lows. This bullish divergence suggests that selling momentum is weakening despite lower prices, signaling a potential upward reversal. On the other side, bearish divergence occurs when price makes higher highs while the RVI forms lower highs. Here we can see the price continues to rise, reaching new highs, but the RVI indicator is making lower highs. This bearish divergence indicates that buying momentum is weakening despite higher prices, warning of a potential downward reversal. Let's summarize the key points about RVI divergence analysis. Divergences signal potential trend reversals before actual price action confirms them. Bullish divergence occurs when price makes lower lows but RVI makes higher lows, signaling a potential upward reversal. Bearish divergence happens when price makes higher highs but RVI makes lower highs, indicating a potential downward reversal. These signals become more reliable when confirmed by actual price action or other technical indicators. RVI divergence analysis is most effective when used in established trends that are showing signs of weakening momentum. Most modern trading platforms include the RVI indicator in their technical analysis toolkit. To set up the RVI indicator, first locate it in your platform's technical indicator menu. After selecting the RVI indicator, you'll see the chart area where the indicator will be displayed. The standard settings for RVI use a 10-period calculation for the main RVI line and a 4-period for the signal line. The RVI indicator typically appears in a separate window below the price chart with values ranging from 0 to 1. You may need to adjust these parameters based on your trading time frame and strategy. For day trading, consider using shorter periods, typically between 5 to 7 for the RVI line and 2 to 3 for the signal line. Swing traders usually benefit from the standard settings of 10 to 14 periods for the RVI line and 4 to 6 for the signal line. For position trading or longer-term analysis, consider extending the periods to 14 to 20 for the RVI line and 6 to 8 for the signal line. Here are some additional tips for optimizing your RVI setup for your specific trading strategy. Remember that finding the right settings requires experimentation and should align with your overall trading approach. We'll explore 4 proven strategies for trading with the Relative Vigor Index. The basic RVI trading strategy involves entering trades when the RVI line crosses the signal line. A bullish signal occurs when the RVI crosses above the signal line, while a bearish signal appears when it crosses below. For bullish entries, look for the RVI to cross above the signal line. This indicates increasing buying momentum. For bearish entries, look for the RVI to cross below the signal line, showing increasing selling pressure. Always consider the direction of the overall market trend before entering any trade based on these signals. For more conservative trading, wait for both a signal line crossover and a center line crossing. First, identify the initial signal when the RVI crosses above or below the signal line. Then, wait for the RVI to cross the center line at 0.5 for additional confirmation. This conservative approach generates fewer signals, but generally produces more reliable trade entries with higher probability of success. Divergence trading is another powerful RVI strategy. This occurs when price and the RVI indicator move in opposite directions. Bearish divergence forms when price makes higher highs, but the RVI makes lower highs. This suggests weakening momentum despite rising prices. Similarly, bullish divergence occurs when price makes lower lows while the RVI forms higher lows, indicating potential upward reversals. Divergence signals are especially powerful when they occur at key support or resistance levels, where price is more likely to reverse. Proper risk management is essential for any RVI trading strategy. Always protect your capital with appropriate stop-loss placement. For long positions, set your stop-loss just below a recent swing low. This gives the trade enough room to breathe while limiting potential losses. Similarly, for short positions, place your stop-loss just above a recent swing high to protect against unexpected upward movements. Always aim for a favorable risk-to-reward ratio of at least 1 to 2, meaning your potential profit should be at least twice your potential loss. And remember, never risk more than 1 to 2% of your trading account on any single trade. Let's summarize the 4 key RVI trading strategies we've covered. Let's explore the key limitations of the Relative Vigor Index indicator. The first limitation is false signals in choppy or sideways markets. When markets trade in a range without clear direction, the RVI can generate misleading buy and sell signals that lead to poor trading decisions. The second limitation is lag during rapid price movements. When prices change rapidly, the RVI indicator often signals too late, as it needs time to register the momentum shift. The third limitation occurs during periods of low volatility. When markets enter low volatility phases, the high-low range decreases, causing the RVI denominator to shrink. This results in an unresponsive indicator that struggles to generate meaningful signals, even when small price movements occur. The fourth limitation relates to irregular trading markets. The RVI indicator heavily relies on the relationship between opening and closing prices. This creates specific issues in markets with irregular trading hours or low liquidity. These include overnight gaps where RVI misses price movements, low liquidity situations with irregular price formation, and half trading days that alter the open-close relationship. Let's summarize the key limitations of the RVI indicator. First, it can generate false signals in choppy sideways markets. Second, the indicator may lag during rapid price movements. Third, during low volatility periods, the RVI becomes less responsive as the high-low range decreases. Finally, be cautious when using RVI in markets with irregular trading hours or low liquidity. As a best practice, always use the RVI indicator alongside other technical tools for confirmation, rather than relying on it in isolation. Advanced traders can modify the RVI indicator to suit their specific needs and market conditions. One of the most common modifications is adjusting the look-back period to optimize the indicator for specific assets or timeframes. A shorter look-back period creates a more responsive indicator that reacts quickly to price changes, which works well in volatile markets, while a longer look-back period produces a smoother line that filters out noise, making it better suited for trending markets with less whipsaw. Advanced traders often create custom indicators by combining the RVI with other technical tools. One popular approach is combining the RVI with volatility filters, such as the average true range or Bollinger Bands. This combination helps reduce false signals by confirming RVI movements with volatility conditions, improving overall signal quality. Another advanced application is using the RVI for market regime identification. Consistently high RVI values often indicate strong trending markets, where momentum strategies tend to perform well. While fluctuating RVI values near 0.5 suggest ranging or choppy market conditions, where mean reversion strategies might be more appropriate. These adaptations help traders tailor the indicator to their specific trading styles and market conditions. To summarize, advanced RVI applications include optimizing look-back periods for specific assets and market conditions, adding volatility filters to improve signal quality and reduce false triggers, adjusting signal thresholds based on the time frame you're trading, and using the RVI patterns to identify different market regimes for strategy selection.